All right, here we go. Hey, Facebook family, this is Travis Witherspoon. Let's start that over again. Hey, Facebook family, this is Travis Witherspoon from Carter Capital, helping you fight for your financial freedom throughout the Forex market. Today is part 2 of our overall 5-part webinar series, which is called The Setup. Remember, it's an interactive session to where we actually end up talking about everything that you need to know when it comes down to being able to get started for Forex trading. I actually end up starting a little bit later on the Carter Capital page, so I'm actually going to end up pushing this over to my main page so you can be able to hop in and interact with me and interact with all of the stuff that we have going on. Remember, this is a interactive session, meaning that everything that we end up going through, you can be able to ask questions on the fly. So you can be able to understand most of the stuff that we actually end up talking about. So I'm going to wait for a brief second so people can actually be able to log in and be able to get onto the page. Once you end up getting onto this live video, if you want to be able to ask questions, you want to be able to learn more information, you can be able to go from there. Now, while I'm actually going through this and placing in that information, what I'm going to do right now is actually place in this website that you can be able to go to. If you want to hop in and get a free webinar about one of our new up-and-coming courses that we have going on, you can go to cartercapital.com/start here and be able to click onto that actual link, and from there be able to click onto the page and be able to see some of the things that we have to offer from there. So like I end up saying, this is going to end up being more interactive. So if you have any questions, if you end up logging in, if you end up paying attention or reacting or do anything else like that, go ahead and ask questions. This is the best time to be able to do so. Don't leave this session, especially if you end up starting to watch the video and leave off confused or leave off by not asking any questions. It's very important, especially if you're interested in being able to invest in yourself, for you to be able to get as much information as possible before you end up getting started in your overall trading career. So I'm going to wait for probably about another minute or so. While I'm doing that, I'm actually going to end up showing up the page for the disclaimer. We actually end up going through the disclaimer, then after that starting to rock. Now, remember, this is set up to where it end up being right around 40 minutes, 45 minutes at the most. And once again, that's based off of your engagement. I can actually be able to stop. I can be able to stop this off a little bit faster if we're just looking at this as a pre-recorded video. But Kenyon, how you doing? Hope everything's going well with you. Let's see, but I'm going to cut over to the screen right now. Happy to have you on. You have any questions while we're actually going through this, please don't hesitate to write in. Now, in our disclaimer, let's go ahead and talk about this. I'm not a CPA, which means that I'm not going to end up telling you whether to buy or sell. That's not my job. I don't do that. What I end up doing is giving you education and letting you be able to learn how to be able to Forex trade so you can be able to make the best informed decision that you can be able to make when it comes down to your overall trading career. Now, understand this. Anytime that you trade and you place your money in, it involves risk, and there's a risk of you being able to make money, and there's a risk of you being able to lose money or lose all of your money. So it's very important to get a mentor, very important to be able to trade and have good equity management while you're actually going through it. And understand some of the stuff that I end up talking about in these webinars. We end up showing some examples that is for educational purposes only. And past performance is not indicative of future results. So with that being said, I'm actually going to end up going on. I'm actually going to take myself off the screen, and I'm going to hop in and go on to some of the pages so we can be able to get started. Aaron, how you doing? Hope everything's going well with you. Thanks for hopping in. Thanks for at least looking at the webinar. Please make sure that you end up writing back to me, because I want to make sure that my sound is good. Just make sure that you end up saying hey or anything else like that. You actually just got set up to where we're getting ready to start. So in today's presentation, what we're going to end up discussing is we're going to end up talking about the types of traders. We're going to end up talking about trading terminology. We're going to end up talking about currency pairs. We're going to end up talking about the waves of trading. And we're going to end up talking about price action. And that would give us the chance to actually be able to go onto a chart, be able to take a look at some examples, and be able to move on from there. But with that being said, we believe that knowledge is the most powerful weapon that anyone can be able to use, right? And that's with any type of education that you end up getting, but especially when it comes down to being able to invest and being able to trade for yourself. If you understand how to be able to do it, and you understand why the market is moving the way that it is, then you don't have to pay someone else to be able to manage your own money, right? That's the whole purpose of these sessions that we're going through over the course of this week. I want you to be able to gain the knowledge so you can be able to use that to be able to, one, manage your own money, but two, also be able to have the confidence to be able to make a trade and understand why you're making that trade and see the results actually end up happening from there. Now, with that being said, there's going to be a lot of people inside of this room and a lot of people that's going to end up watching this video over the course of the next few days. And you're going to fall into these 4 different types of traders. Now, this is based off of personal preference, and this is based off of your overall time that you can be able to trade inside of the market. The first one is a scalper. A scalper basically places trades with the expectation to be able to hold that trade for minutes to an hour at most, meaning that they get into a position, they end up putting in a high leverage amount. They're going after a certain pip amount or a certain dollar amount to be able to get in and be able to get out when it comes down to the trade. David, how you doing? Hope everything's going well with you. Now, inside of being able to place in that trade, they know that if it gets away from them, they're trying to get out very easily for a break even. If the market ends up getting into that position, they end up taking their money and they go from there. Now, once they end up hitting the daily goal, then they're not trading anymore within that day. So they can be trading from every bit of 15 minutes, hit their goal, and then be done for the day and start over. Or they can be there for probably about an hour or so just to be able to get to that same position as well. Now, day traders are similar to scalpers, but they typically enter and exit trades that are high leverage before the day is actually over with. So the primary difference between a scalper and a day trader is that a scalper literally is trying to go after a certain amount, right, throughout the day. A day trader may go after that certain amount, but they know that all of the trades that they end up taking are going to end up being closed out towards the end of the day, whether if they end up winning or actually losing within that actual trade. Now, swing traders are people that end up entering a trade with the thought process of saying that they're going to stay in that trade for one day or several days at a time. And this is where I kind of fall in, because I understand that where the place that I actually work doesn't allow me to be able to watch the charts as much as someone else that may have that free time to be able to look at the charts for a short amount of time, get into a position and be able to get out of it. But for a swing trader, what this allows you to be able to do is go after large sum of pips and allow you to be able to stay away from the charts and let the market move in its overall direction. Now, position traders are traders that will end up placing in a trade, and they know that they're going to end up being in that trade for several weeks, months, and sometimes years. These are 4 basically mindsets of overall trading, and some people actually end up having or basically end up trading maybe 1 or 2 different styles. I know me, I kind of end up kind of swinging back from being a swing trader and a day trader. Some positions that I end up getting into, I don't want them to be position trades, but because of where the market is actually going, how long it actually ends up taking it to be there, sometimes it actually ends up being a position trader. But me, myself, I'm primarily a swing trader at this point. Now, thanks for joining in. If you have any questions while we actually end up going through it, please don't hesitate to ask while we're going through this. Quentin, what's going on? If you have any questions while we're actually going through this, please don't hesitate to ask while we're actually going through the types of traders. You actually just hopped into, I think, the 2nd or 3rd slide. So if you get stuck, you can go back to the beginning of the live stream after everything is over with. But good to see all of y'all. Now, the positives and negatives of a scalper is the positive is that you can gain a large sum of money in a little bit of time because you leverage your account to where you're going after let's say $100. Then that means that, to give you an example, let's say if you have $1,000 inside of your account, depending on the leverage and depending on the broker that you end up having, you can use almost 3 to 4 mini lots on a trade within that and not go past your overall margin. Meaning that what that does is it allows you to only go, this allows you to be able to go for a short amount of pips and be able to make a large gain. So to give you an example, if we're going out there, if we're going $4 a pip and you're trying to make, or yeah, let's say $5 a pip, just to kind of help it out, and you're trying to make $100, then that means that you only need to go out to 20 pips to be able to get that, and then you can be done for the day. Now, a negative of that is that you can typically over leverage your accounts, which may lead to you losing money very quickly within your overall trading time throughout the day. Now, once again, as a scalper, you really having the mindset that you're trying to get in and get out. So typically, when you're seeing that the market is basically getting away from you, you're typically cutting your trade short and trying to cut your losses so you can maximize your gain. But if you keep on doing that over and over again, then it can kind of eat into your overall account. Now, day traders are trying to get in and out of trades within the day. Now, obviously, they're doing that with larger sums amount of money, but they're going through the whole day and trying to find certain positions for his overall trading. Now, the negative of that, it could lead to consecutive losses, kind of like with scalpers, because typically when you're looking, or the charts that you look at, or the time frames that you look at for the day trader is actually shorter term time frames, which means that you're not necessarily getting the full picture about what's going on with the market while it's actually going from there. Now, a swing trader, the positive is that it allows you to be able to monitor the market less, meaning that if you work somewhere else and you don't like staring at the charts, you don't like being in your seat all the time, what you can be able to do is possibly be able to look at it maybe 1 to 3 times a day and just be able to check up on what your actual trade is doing within that time. Now, the negative of that is that you kind of lose out on short-term gains. So you're actually playing the long game when you're making trades as a swing trader, meaning that you won't get the seismic move of a account like a day trader or a scalper, to where you can see your trade go from 1,000 to 1,100 in one day, or 1,000 to 1,500 in one day, based off of that movement. But what you'll end up seeing over time is that swing traders are a little bit more consistent on being able to make long-term gains compared to short-term gains, especially when you start to get more confident in your trading. Now, position traders, the positive is that you end up gaining a huge amount of pips with patience. And I'm going to end up saying this again, it is with patience. Because remember, you're going to end up taking trades with the overall thought process that you're going to end up being in it for a longer amount of time. Now, the negative is that you can stay in a trade for weeks to years. Now, that's the one negative about it, but you have that mindset that you're going to end up trading in that overall way in the first place. Wesley, how you doing? Hope everything's good with you. Now, with that being said, I'm going to pause here for a quick second. If you're still on the live stream and you have any questions from this point, this would be a great time to be able to ask. And so you can be, before we actually end up moving on to trade terms. What we end up talking about in that previous session, we actually just talked about the types of traders and which ones are the positives and the negatives of it. What we're getting ready to go into now is trading terminology. So if you're interested in being able to learn a little bit more about that, once again, you can be able to go to that website that I end up placing in on the chat site and be able to get some more information about that, and we can be able to go from there. All right, now let's talk about some common information that you probably need to know, and we'll end up helping you out, especially when you're looking at your overall brokerage. A currency pair is a quotation of one currency against another currency. An exchange rate is the value of one currency in terms of another. And we'll get into that a little bit later on. A quote is labeled as a market price that is always consisting of two different figures. Now, the bid price is the price that sellers are actually looking for, and the ask price is the price that buyers are looking for. We actually end up going through that in yesterday's session while we're going through what is Forex. So hopefully that kind of reminds you of what we ended up doing yesterday. A pip is the smallest increment of a price movement that a currency can be able to make. Kind of like what we ended up talking about yesterday. Remember, the US dollar, the smallest increment of a US dollar is a penny. There's 100 pennies and a dollar. Anytime that the market moves 1 penny, then the market moves 1 pip. All right. And then after that, you have the axe price. The axe price is the price that you can buy the base currency. Now, moving on. The bid price is the price that you will end up selling a currency pair. From there, the way that you end up trading that is based off of lots. Now, understand that Forex is traded based off of lots, and what you end up seeing is units when you're actually placing in how much you want to be able to leverage. All right, so one standard lot has 100,000 units of base currency. A mini lot has 10,000 units of base currency, and a micro lot has 1,000 units of base currency. Margin is the minimum amount of funds that you would need to have to open a position and keep a position open. To give you an example of this, let's say if you're looking at buying a home or buying a car or anything else like that, that is basically your down payment that you have to place down before you actually end up getting placed inside of a trade. So that's the money that's being held in your account. Now, leverage is the amount that a broker will lend to you that allows you to be able to have bigger trades. Now, or be able to have bigger lots. Now, this is a double-edged sword because in the United States, they allow you to be able to trade 50-to-1 leverage, meaning that, let's say if you have $1,000 in your account, then it's going to be treated like 50,000 units inside of your account, which allows you to be able to trade more than what you actually have in your account, which allows your account to be able to grow over time, but it does the same thing for the negative. So if you end up losing on a trade, then you can be able to lose at that same type of rate that you're actually leveraging. So it's very important to be able to manage your equity. Now, equity is the total amount of money that you have in your trading account, including your profit and losses. Now, let's talk about orders at this particular point. A market order or an entry order is the order to buy or sell a currency instantly at that current price. Now, remember what we ended up talking about yesterday was that if you end up looking at that and you end up clicking on buy or sell, sometimes slippage can end up happening, meaning that you might want to buy it at one number and you get it at another number. Now, sometimes that can be a positive, and then sometimes that can also be a negative. A limit order is placed away from the current market price, which means that this is the price that you actually want to be able to get into, but you may not. Sometimes you may end up getting triggered in the trade. Sometimes you may not. It has to hit your limit order plus the actual spread to be able to get into that price. A stop loss is an order to exit the trade at a loss that is predetermined, and a take profit is an order to enter to exit a trade in a profit that is predetermined. And it's very important to be able to understand equity management, which is a trading plan that focuses on your risk to reward ratios. Now, from here, if you have any questions to be able to ask or anything else like that while we jump into currency pairs, this will be a great time to be able to talk. I'm actually going to get just a quick swig of water, and we'll go ahead and move on in a quick second. All right, so if there's no questions, we'll go ahead and move on. Now, there are, last time I checked, I think it was almost 38 different currency pairs that you can be able to trade from. Now, really and truthfully, I only focus in on 8, but I have 10 on the screen because some people actually end up looking at these other trading pairs, and you may end up trading them just because that may be your base currency. So I'm going to end up having these on so you can be able to look at it and go from there. Now, The symbols are very important to be able to understand and know what they actually are, because when it comes down to being able to communicate with somebody and being able to understand that, especially when they end up writing that down, it's very important to know exactly what they're talking about for his overall trading. So if we say USD, that means the United States dollar. AUD is the Australian dollar. CAD is the Canadian dollar. NZD, or the New Zealand dollar, is that actual position. CHF is the Swiss franc. EUR is the Eurozone. GBP is the pound sterling. JPY is the Japanese yen. Then after that, you have the CNY, which is the Chinese yuan, and the MXN, which is the Mexican peso. Now, with that being said, when you're looking at the exchange rate, and both of these are kind of set up in pairs, from this point going forward, I'm going to end up having one in green and one in red. Remember, we end up talking about the bulls basically want the market to move up, the bears want the market to move down. It's always a competition between both of those pairs and both of those people to be able to make the market move in a direction. Okay, and whoever gains control ends up telling which currency is actually going to end up being strong. David, how you doing? Hope everything's going well with you. So the pair that's on the left that's in green is the primary or the base pair. So in this case, we're looking at the US USD, we're looking at the US CAD in this case. So if the market actually moves up, then that means that the US is getting stronger and the Canadian dollar is getting weaker at that particular point in time between both of those pairs. Now, if we see that the market is actually going down on this chart, then that means that the Canadian dollar is getting stronger, or the secondary pair is getting stronger, and the US dollar is getting weaker at that particular point. All right, so from there, take a look at another example. Now we can see we have the Eurozone versus the dollar. All right, so now in this case, if the market goes up, the Eurozone is basically getting stronger and the dollar is actually getting weaker in this case. Now, consequently, if the market goes down, then the US dollar is getting stronger than the Eurozone. Now, here's the problem, especially for people that are actually getting started off in the trading. You can look at both of these and you can be like, wait, what's happening? Because you can see that one market is going up and one market is going down, and in the same case, but one pair is actually getting stronger than the other one. What actually happens between your broker is that the way that they label it is how it's going to end up being shown on the chart. So let's say in this case, if the US dollar is getting stronger over both of these pairs, you'll see on the US CAD that is going up on that chart, and you can see on the euro dollar that is actually going down on that chart. That still means that the US dollar is getting stronger than both of those overlining pairs. All right, so it's very important to be able to understand that. Now, consequently, if the market is going down on the US CAD and going up on the Eurozone, then that means that the US dollar is getting weaker than the Canadian dollar and the Eurozone respectively. Type in a Y yes if that makes sense, because that's very important to be able to understand while you're actually looking at the charts. And I don't want you to get confused about that while you're actually going through it. Okay, so with that being said, another pair, just to kind of take a look at it, you got the pound sterling and you have the Japanese yen right here at this point. So the pound will end up being the base currency, the Japanese yen will end up being the secondary currency on this one. So it'll allow you to be able to understand what's going on with the overall movement of the market between both of them. All right, moving on. There are 7 major pairs that we primarily trade from, and there's 28 different pairs that you can choose from if you end up taking out the Chinese yuan and the Mexican peso. Now, with that being said, that kind of goes back to what we ended up talking about yesterday, being compared to seeing 1,000 different, almost 10,000 different types of stocks that you can be able to trade from, and only looking at 28 different pairs of actual currencies. Because you have that, you can be able to focus in a little bit more on being able to focus on either the 7 major pairs or being able to branch out and looking at all 28. But let's go through some of the names. So when somebody ends up saying this to you, you'll be able to understand what they're saying. If they say Aussie dollar, that's the Australian dollar versus the United States dollar. Then you have the euro dollar, that's the euro versus the US. You have the pound dollar, which is the pound versus the United States. Then you have the Kiwi dollar, the dollar CAD, the dollar Swiss, and the gopher, also known as the dollar yen, for those overall pairs. Now, once again, remember, the pair that's on the left is the base currency. So that means that if the market is going up, then that currency is getting stronger compared to the secondary currency. If the market is going down, or you see a lot of red candlesticks, then you end up noticing that the secondary pair is actually getting stronger than the base pair for its overall movement. Now, with that being said, if there's any questions from this point in time, please make sure that you go ahead and ask them before we start talking about the ways of trading. I'm going to go ahead and pause for a brief second, allow you to be able to ask questions if you have some. This would be a great time to be able to go ahead and ask when it comes down to that, and we'll end up moving on. Okay, so let's go ahead and talk about the ways of trading. Now, the market only moves in two directions. The market can only move up or down. Now, for the people that have been trading before, you end up saying, well, what about consolidation? And I do agree with that. That means that the market is basically moving through a range of support and resistance. But at the end of the day, what actually happens from that support and resistance, once it's actually broken, then it moves up in a up or down direction. So consolidation to me is just a temporary pause of overall movement. All right. So with that being said, let's talk about what happens in a uptrend. In a uptrend, what actually happens is the market creates higher highs and higher lows within that actual movement, and then it starts the sequence all over again. Now, when you have consecutive higher highs and higher lows, then that means that the trend is actually starting to be formed, and sometimes you can end up seeing long-term uptrends, especially on shorter-term time frames, to be able to see what's going on with the market. And remember, they always say that the trend is your friend, so you always want to be able to trade with the primary trend of what's going on with the market. Now, the opposite of an uptrend is a downtrend. In a downtrend, the market creates lower lows and lower highs in the market. So if we look at this chart down at the bottom, you can see that the market actually ended up dropping from a high price to a low price. From there, end up retracing. From that retracement, it ended up making a lower high, and then after that, creating a lower low, which will end up being the lower price from there. Okay, so I hope everything's going well with you. And then going from there. Now, what this allows you to be able to see and be able to notice is that these waves create predictable patterns. Some of the patterns that you will end up seeing are ABCD patterns. You will end up seeing crowns, whether if they're bullish or bearish. You can end up seeing head and shoulders patterns, or you can end up seeing triangle patterns or harmonic patterns and everything else like that. For someone that's just getting started, I only want to focus in on one thing right now, which will end up being ABCDs. Now, what happens in an ABCD uptrend is that consists of a B rally to a B to C retracement to a C to D extension. So essentially what happens, if we're breaking this down, the market moves up, goes to a high price, then the market actually ends up basically falling down. From that low price to the high price, from that AB, it creates a support and resistance. As long as the market does not break the support of the A, then the market will end up continuing and making a new higher high from that particular point. All right, meaning that from that C going to the new D extension, it's going to end up creating a new higher high from that point. Once the ABCD sequence has been completed, then the market will end up starting that phase all over again and then being able to move up from there. Now, in a downtrend, it consists of an AB drop from a B to C retracement to a C to D extension. So in this case, the market moved from a high price, sellers started to sell it off. From that sell price, the market started, it ended up getting to a lower price, rejected and halted from that support, and then after that, went back up. And as long as the market did not break the resistance at that particular point, the market will end up creating a new lower low, which was the extension. Now, inside of the market, you can see this happen consistently over and over again, and strong trends have strong ABCD movements within the market, and it creates price action that you can be able to work out from. So this is the last section that we're going to end up talking about. If you have any questions from here, once again, please make sure that you end up asking, so we can be so I can be able to accommodate those questions and be able to move on. But while I'm actually going through this, I'm actually going to show a chart. And hopefully that will end up helping you out for being able to understand the actual movements of the market. So take a look at a uptrend, and let's take a look at a downtrend on this one. From here, we're actually going to take a look at the 2-hour chart in the market from here, and I'm going to erase all of these lines because I want to show that over again, so we can be able to fully get a good grasp about what's going on with the market. Now, all of the stuff that we end up talking about right here, we talk about in our Fibonacci Fundamentals course. If you're interested in being able to know and learn a little bit more things about Fibonacci trading and being able to go from there, you can definitely go to that website that I have placed up in the first comment. Click onto that, grab a seat for our next upcoming class that we have, and then after that, be tapped into what is actually going on and be able to learn that information. So let's take a look at what's going on with this first movement. Now, remember, the market is basically set up in the ABCD swings, or this ABCD movements from there. Now, not every ABCD swing is the same, so I will say that. But what you'll end up noticing is that the market is actually moving from a low price to a high price. From that low price, from that high price, it basically drops to a low price. From that low price, it basically goes to a newer high. All right. So it's the same thing that happens over and over again. So to give you an example, we look right here. The market ends up having this low price. From here, it ends up going to a high price in that movement. All right, let's start this over again. All right, so from here, market ends up having a low price. It ends up moving to a high price. From this high price, there goes your A to your B. Now, as long as the market does not break that support or that A, then the market will end up creating a new higher high. All right, so we can see that it almost touched the low, but it did not break the low of that overall movement. From there, the market ended up creating a new high, and it broke the support, all right, the resistance of this B right here to this new high right there. So in this case, you have A to B to C to D. Right? From that D position, the market starts all over again. C turns into A, D turns into B, and then the market basically swings and goes from there. Now, what typically happens is that from the breaking of this resistance at this point, we can be able to see, in which I'm going to place this in, orange so everybody can be able to see it. Or better yet, let's place it in a different color. Let's place this in blue so everybody can be able to see it. We can see that the market basically ended up rejecting from this new resistance and going down and testing where this support was. Now, when it ends up breaking that past resistance, it will turn to future support and basically test that area. Now, what happens with people, just in general, people like to see that the market will basically retrace and get somewhat close to the previous resistance, or the previous resistance turn new support and actually trade from there. Now, from here, what ended up happening is the market ended up creating a new C. From that C, it actually ended up extending up and making a new D position. Now, you can see that the market actually gapped in this position and then created a new AB boundary. So now, from here, this black line to that black line, you have your support, you have your resistance. The market ends up retracing from that movement, from that retracement, as long as it does not break the support in this case, then more than likely the market will end up moving into a new higher high. All right, so we go right here, we move this out the way. It actually put the trend line back up here. We see that it broke that resistance again right here and moved into a new higher high. And now you can see that the market basically ends up doing that same thing over again. So this is the movement of 1, 2, 3, 4, 5 different uptrends that basically end up happening, making it predictable about what you would want to do in a trade in this situation, right? So we look at it right here. We got our new low from this position right here. We have our new high from this position right here. It ends up breaking. This is a new completion of a de-extension. The market actually ends up moving down, in this case again, to a new low. And from here, based off of the people that have been paying attention, all right, based off of this position, what is expected to happen, right? We can see based off of this purple line, we can see that the market is basically moving. Is the market expected to go up or go down? Is the market expected to create a new high or expected to go down at this particular point? What's going on, Tristan? Now, in this case, the market will end up making a new high, right? It's expected for the market to make a new high. Now, like with everything that we end up saying, not every ABCD sequence is the same. The market will end up moving to a new high, and it will take its time to be able to get up there, but it's expected to be able to go to that new high right around 152. Now, by being able to understand that and know that information, and know how to be able to trade that information, it makes it a little bit easier for you to be able to predict what's going to end up happening in the market. Now, that's a uptrend. Let's take a look at a downtrend. And I'm going to kind of play off of what we ended up talking about a little bit earlier with our currency pairs. What we can see right here in this uptrend where we have the US CAD, we can see that the US dollar has been gaining strength over the Canadian dollar, right? Now, if we go over and we take a look at the Australian dollar compared to the United States dollar, we can see that the market is actually moving in a downtrend. So we have a drop to a retracement, from that retracement to a new extension, right? So this support and resistance was broken. The support was broken. They end up finding a new support, right? From there, the market ended up going up, did not break the resistance. It ended up breaking the support again and finding a new support to complete that de-extension, which is right here. Now, the market is in a moment of where it almost hit the de-extension, but it did not complete. It's starting to move in this position, and it has not broken the actual resistance. So it's expected for the market to be able to move back down and complete this overall extension before going back up. Now, in the case that the market ends up breaking the actual resistance in a downtrend, meaning that it breaks the A or breaks the sequence, then that means that a new position or a new ABCD sequence has to be created, meaning that you end up seeing now a rally compared to a drop, a retracement, and then having a new high. Now, what that has created is a crown, in which that's something that we end up talking about inside of our course. Now, as we get ready to close out of here, because we end up saying that we're going to end up getting out of here at 3:45, which is about 3 minutes left. I encourage you, if you end up liking the information that I end up talking about, please make sure that you end up going to Carter Cow Capital, cartercowcapital.com/start here, which is actually on that link. And placing your information that you want to be able to hop in and go to one of our free webinar courses about Fibonacci fundamentals. That is the course that we're basically pushing this month and being able to get people to be able to understand. It is a fundamental course for people that want to be able to learn how to be able to trade that actual style that I was just talking about, and get mentorship while you're actually doing it. Now, when you end up going to this website, please make sure that you enter in your email address, your first name, last name, your phone number, and down here, what you'll need to do is go to Fibonacci Fundamentals and be able to place that in. Once you end up hitting subscribe, you end up receiving an email will basically let you know what time you're actually going to end up being placed in. Your seat has been reserved. We're basically thanking you and giving you some more goodies from there. As soon as you end up attending and reserving your seat, you actually end up getting a copy of my book for free, which is called Success in Forex. But one other thing that you can be able to do is this: if you click on join the session, when you click on join the session, we'll actually end up taking you to a pre-recorded webinar talking about trade rankings. And this is one of the things that we end up talking about inside of our Fibonacci's fundamental course that allows you to be able to understand how we end up breaking down our trading sections and be able to simplify your overall trading experience to where it's only in 5 different groups, to where it's very predictable movements within the market. Then from there, because you end up signing in, all you have to do is click on this book or click on this link right here. From there, you end up getting a copy of the book Success in Forex. Now, for everyone that end up staying and going within that overall time to watch this whole thing, one, I do appreciate your time and your patience and everything else and actually going through it. Tomorrow, what we're going to end up talking about is we're actually going to end up showing how to be able to choose from a broker. Which broker would I actually choose from? How much money you actually should start off with when you're coming down to trading, and equity management. All of that stuff is very important for the people that are going to end up being in that live session. We're actually going to end up helping you create an account. So like I said, it's very important for the people that end up going inside of this live account. It's cool that you end up watching. It's cool that you end up placing your face in. But if you really want to be able to learn some information, interact with us, be able to talk with us in the chat panel, so we can be able to help you out get started in your overall trading career. Once again, everything that we're doing from this point is absolutely free. There's no money involved or anything else like that. I'm really just trying to get you started on being able to learn how to be able to get traded. Now, if you decide to be able to go through and continue with us and be able to go through our Fibonacci Fundamentals course and everything else like that, obviously we'll end up offering you a price to where you can be able to do that. But over the course of from now Wednesday all the way through, it's going to end up being totally free for you to be able to get all of the education and knowledge that you truly need. But until then, one, take care of your loved ones. Make sure that you end up staying safe. Make sure you stay isolated. Protect everybody else from there. And like always, plan your trade, trade your plan. Everyone, y'all end up having a good one.